And when rapid speed down to 2,500.
Good point. Wherever you reduce speed to 180.
Black Box.
Hey gang, Kenny Porter here. Welcome again back to KP's Black Box. Today I got a super awesome guest, and this guest is a CPA turned mortgage broker. So he left the dark side, came over to the darker side, maybe, right?
Sometimes.
The great Mr. Patrick Bowler. Pat, thanks for being with us today, man.
Thanks for having me, Ken.
Yeah, it's awesome. I'm looking forward to having this conversation with Pat today. Pat and I actually have crossed each other's paths over the years. You know, being me and my real job being in financial planning, running a financial firm, and then Pat. In the days that I knew you early on, it was actually me and my old business partner at Velocity Capital.
Yep.
Back in those days, Jay Matthews. I don't know if you remember
I
Jay
do
or
remember.
Brian LaRoche. Those
I
guys.
remember both of them, yep.
Yeah, good dudes. But you were doing taxes back then, if we want to just
Yeah.
keep it simple.
Yeah.
But tell people a little bit about yourself and how does a person become crazy enough to want to be a public accountant?
Well, I can tell you this much. It wasn't a typical transition. I didn't go, from high school to college and then say I wanted to be a CPA.
Yeah.
I kind of went from high school to college and then took a long-term exodus from that and kind of got into the restaurant and bar industry.
Interesting.
Crazy as that sounds, and worked for a gentleman locally here in Virginia Beach and managed some nightclubs for him, and became very, very successful nightclubs. They were probably the busiest clubs in Hampton Roads at that time.
Can you name them?
Yeah, one was called the Heartbreak Alley. One was
okay.
called the Heartbreak Cafe.
Yeah, I remember.
And, they were just unbelievable. And I've always been a numbers guy. And the gentleman that owned that club, both those clubs, was also very numbers driven. As a matter of fact, he came out of Wall Street, came back here to help his family out and stuff. Really great individual. But the thing that really got to me was every month I would sit down with his CPA and we'd look at numbers. And I remember I was getting into a point where I was tired of working late at night, especially because I get up early every morning, regardless of what time I go to bed, or I try to anyways. And we were talking, and and I just really started getting intrigued as to his insight into business and into how he could tell us when people were stealing or when things were being given away or when the numbers just weren't right. And so I met with him a number of different times. And at that point, that's when I kind of took a leap of faith. I was like, well, let me go back and finish this degree and, get my CPA license. And, that was while working nights and everything else. And it went fine. It's amazing when you're paying for school.
How serious you'll take it.
How serious you take it. I mean, I was there. I don't think I missed a class. And I was never late. I had some fantastic professors over at Old Dominion University that I cannot say enough good things about.
That's
and
awesome.
So I did get through it. Sat for the exam, ended up finishing it up in two takes. And was lucky enough to get picked up by a very good public accounting firm, which the name at the time was called Whitmeyers and Companies.
A very respectable firm.
Yeah, they're now. I mean, they're one of the largest regional firms in the state. They're called PB Mayers now, and I just had some great people. I mean, the managers there, the partners at that firm were just unbelievable. I couldn't have asked for any better guidance through the beginning of my career. So, yeah. That's how I kind of got into it.
That's awesome. That's pretty crazy that, having the experience as a business owner, business manager outside of accounting, it sounds like you could really bring some experience to the table of saying you could empathize probably more with a business owner you were in operations, right? So
Absolutely.
What impact do you think that had on your public accounting or your tax preparation with clients?
Oh, it was amazing. I mean, we'd go in and do audits of companies, and it was just nice to sit down with people that were in the trenches, and recognize what they're going through. And we did a lot of work actually with restaurants and nightclubs, or more food service industry. I wouldn't say nightclubs. And it was nice because I just had the experience, so I knew what was going on. I could understand where they were coming from.
So this is not your first time wearing a headset. Then, if you were in the nightclubs, were you in the DJ booth?
No,
That's not your game.
No, the only time I was ever in the DJ booth is if they were doing something wrong, and that was not unusual either because DJs, they're fond of drinking a few cocktails and stuff, and there's a lot to be said for what the DJ is doing. That they control the tempo of the nightclub,
Right.
And if they're not doing their job,
They can
right,
bring it up or take it down quick.
they can
right?
cost a nightclub a lot of money, and if they weren't doing their job, I obviously wasn't doing mine. And the old saying, "Shit rolls downhill."
Right.
I was always the one to catch the end of it.
Kind of like a CPA too, because you're the best guy on the planet when a client gets a refund,
Right.
and then when you don't, they're like blaming you, like, "Well, what did you do wrong, Pat?"
Exactly. They don't want to hear that they owe money at the end of the year.
Right.
Right.
So we'll talk through that type stuff today,
Yeah.
and we'll talk through some mortgages.
Yeah.
But before we get too deep, you were talking about having a few drinks. We're gonna have a drink today early in the morning.
I'm going to preface this. You were talking about having some drink. You just made me pick the poison.
You picked the poison. I'm participating.
Yep.
So you picked Discretion, which is Tarnished Truth, local spirit manufacturer here in
There you
town.
go.
They actually do a really nice job over at Tarnished Truth. And this bottle here is one of their which one is this? This the 3 or 5 year? I forget how long this one is distilled for. They're going to be pissed off that I don't know that. But it's a really nice bourbon for a young bourbon. It hasn't set for a long time, right?
Exactly.
But they also do some private label stuff. You can buy a barrel from these guys.
Really?
And then they will. The other one I have over there on the pub side, a client of mine. Shout out to GBRS, which is the Global Battlefield Resource Solutions. The guy has a couple of old team guys,
Yep.
Which is why we're going to do a toast here in a few minutes for our veterans. But they gave me a bottle of theirs that they bought the whole barrel.
Yep.
And then they were able to put a co-branded private label on it, which is really cool.
Gotcha.
And makes nice gifts for clients.
Yep.
But we're going to drink the Tarnished Truth Discretion today, your pick. And we're going to do a little toast to veterans.
Amen.
We were talking about off camera that you have a close friend who was part of the teams here locally.
Quite a few of them, actually.
Yeah, and great human beings. I always brag and have to boast that I was a Marine or still am a Marine.
There you go.
I've eaten 3 sizes of that dude up there on the wall in that picture, so I'm a little larger than that guy. But what's important to me, Pat, and I know it's important to you too, having close friends in the community, and you can't step anywhere in Hampton Roads without there being a military presence, right?
Yep.
So we always want to give a shout out to our veterans, to those also who are serving now,
Yep.
and those who have gone before us, those that have given the ultimate price
sir.
and sacrifice, and those that are still serving and their families.
Yes, sir.
Like I always want to point out the moms and dads and kids that stay behind when mom and dad go off.
My dad was in the Navy for almost 25 years.
Cheers to him too.
Yes, sir.
Yeah. So, cheers to you guys out there.
Cheers.
Salute. And you can either sip it or we can just crush it here.
I'm just going to crush it.
Good little breakfast blend.
Amen.
That's not bad, right?
Better than a protein shake.
That's it'll make us feel better
Yes.
in about an hour.
There you go.
So, thanks again to all you vets out there. We appreciate you here at KP's Black Box and beyond. So, going from CPA now over into the mortgage world,
Yep.
what was that transition about? How did that come about?
Well, that's not too long of a story, But I had been working for our CPA firm for a number of years, and I was debating on transitioning to a different firm, just for financial reasons more so than anything else. Had considered just skipping a tax season because I used to like to ski at that point in time, and if you're a public accountant, you don't ski. I mean, yeah, not around here anyways, and you really don't have enough time to go out west because you're pretty busy from about December till April.
Yeah.
And so a good friend of mine was in the mortgage industry. He was actually one of the senior vice presidents for National City Mortgage at the time.
Yeah. That's old school.
That's old school. Yeah. And he was a running partner of mine. We used to do triathlon together, and a great individual. And he had been bugging me every once in a while, you really ought to get into this mortgage stuff. And I was like, I'm not a salesman.
Yeah.
I'm like, I like numbers. I'm a CPA, blah, blah, blah. And finally one day we were out on a run, and I kind of was like, well, why don't you tell me about this mortgage stuff? And he laughed, and we ended up getting together, and he was like, well, give it a shot. He goes, I'll guarantee your salary, whatever you're making, public accounting, I'll guarantee it for 6 months. And if you don't like it, no harm, no foul. You miss tax season, life's good. And I'll be honest with you, I got in there, and there's no training in the mortgage industry, to be honest with you, especially back then. I mean, they throw you to the wolves, and you figure it out on your own. Yeah. Which I kind of found a little bit odd, because coming from a public accounting background where you spend half your day training. I mean, that's, they want to make sure you know everything. You go to school for years and so forth, so on. So we got through that, first couple of months of me just scratching my head going, what the hell I'm doing? I just don't, this is crazy. To where I started figuring it out on my own.
And did you get in pre-RESPA changes?
Oh, yeah. Yeah, okay. It was.
And RESPA is Real Estate Settlement Procedures Act, right?
That's Protection Act, yeah.
Yeah, Protection Act.
Yeah, and so it was one of those things where I was like, okay, I hate practicing on the public, and I felt like that's kind of what we were doing, but we were in a big refi boom, so I had stacks of loan files and didn't know what the hell I was doing. So it was like, okay, but we got through it. You just work longer hours, work harder. I wasn't working smarter, but started learning, and I'd ask people questions and get through it all, and and eventually everything came together. It's like it always does, and so roll forward 25 years now. I think it's been. I've been in the business maybe a little bit more.
Wow. Yeah. So what big changes have you seen? And we'll stick to mortgages right now. Today we're going to get into a very taboo subject that later we're going to have some experts come in and talk to us about reverse mortgages. Yeah. And there's probably people turning off the video now, or turning off.
Because you mentioned
reverse. Because I said reverse mortgage. In our financial planning practice, even from a compliance point of view in our industry, did you mention reverse mortgage to your client?
Wow.
And I'm like, well, what if I did? Yeah. I mean, what are the reasons why it's bad? And then if it's bad, prove it to me why it's bad. Yeah. And I don't make a dime to tell people to go buy a reverse mortgage. Right. Or to implement one. But so we're going to get into that today.
Yeah, that's fine.
A little bit, and then we'll have your guys who are the residential
We'll bring them on another time.
Yeah, absolutely. Yep. Because I think it's important for consumers to understand that. But I'd like to kind of peel the onion back on mortgages pre-2008. Yep. And then maybe the Fannie Mae world, or the FHA world, I should say, not Fannie Mae, but the FHA world of regulation around reverse mortgages. Yeah. And then, bring us back to where we are today. Yeah. But back before 2008, the mortgage industry, wouldn't you agree, was kind of the Wild West?
When I first got into this industry, it was really the wild, wild west. And it was to the point when, the industry was doing, quote unquote, liar's loans.
Can you explain what that is?
Yeah.
Liar's loan.
Guy walks into the office, says, I make $100,000 a year, and basically signs a document saying that's what he makes.
We'll sip these, Pat.
Okay. That's good. Or better yet, he just doesn't put anything at all on the loan application, a complete no-doc loan. And there was just no, it was like, my God.
All right, so you're using language again, consumers, no doc loan.
Yeah, no documents, meaning no pay
Literally,
stubs.
no documents.
No documents, signature on on a
Credit score?
credit score. Got to have some credit.
And what would the credit score back then have to be?
God, it ranged. If the interest rate, for the best interest rates, you had a decent credit score. Unfortunately, a lot of people have great credit. They just don't show income on their income taxes.
Yeah.
Quote unquote, their CPA found a loophole or something.
Buried the income.
Yeah, exactly. That was always, and it was always funny hearing those things. Being a CPA, I'd be like, okay. But those are the stories I hear.
You're bullshit.
Yeah, exactly. But needless to say, we didn't have a lot of that here. You saw a lot of it on the West Coast. You saw a lot of it down south in Florida areas. I mean, surely we had some, but not as much in some of the other markets. But those programs, I mean, really, if they were used right, there was no issue.
Yeah.
But unfortunately, people take advantage of things, and they weren't really used right. And, of course, that led to where we ended up at.
So in the pre-2008 era, I remember, and this is the days that you were in public accounting still. You hadn't become a mortgage broker yet. But when I was running my other advisory firm, the days of, what were they called, pay option ARMs, adjustable rate mortgages, or the negative amortization.
Negative amortization, yeah.
And there were people buying these things thinking they were the best thing since sliced bread.
And there was a market for it. And
conceptually,
it was an amazing tool, because if you had that negative am and you took all the difference between that and a fully amortizing payment and you invested it somewhere, at the end of the day, you could make an argument that you might be better off.
I still have a client today. There's not many of them, but going all the way back to my Velocity Capital days, I have a client in the music industry. By the way, shout out to this guy. I don't want to say his name because he gets pissed when I say his name publicly. But he lives here in Virginia Beach.
Yep.
I think he is the third most winning Grammy winner of all time.
Wow.
But back in the day, we had a little mortgage brokerage firm as part of Velocity. It was called Velocity Capital Mortgage. And all I remember is that the commissioner back then, when we got our license to do mortgages, the signature that this guy had was like covered the entire license.
Wow.
Mortgage license. I don't know if you remember. I can't remember his name. He's retired now, I'm sure. But I was like, man, that's a little narcissistic the way you're saying.
Yeah.
Now, I won't probably have the mortgage guys after me for saying this today, but
and you may.
Yeah, sorry. It's public record.
There
I've
you
said
go.
it, but I'm sorry, guys.
Yeah.
State Corporation Commission. I'm not trying to make enemies here.
Right.
But what's more important in this story, Pat, is that this client bought a interest-only mortgage from Thornburg Mortgage. You remember Thornburg?
I'm very familiar with Thornburg. Yeah.
I love Thornburg.
Yeah.
They had a 1 month interest only, went under LIBOR. LIBOR is not even a thing anymore. The London Interbank Offering Rate. Are you impressed that I still remember and know what that is?
Yeah, I'm glad you didn't test me on it.
And now it's SoFi, right?
Yes.
And I don't remember SoFi. Do you remember the acronym? We'll test you. Jake, look up SoFi and help us remember what the acronym is. We're going to test Pat's.
Yeah, I'm going to fail this.
You're going to yeah. You know what? You're failing forward.
There you go.
All right. So SoFi versus LIBOR, Jake, if you can put that up there.
This isn't SoFi, like the SoFi.
It's an acronym.
Like in LA, the stadium?
No, no.
But that's the only SoFi I know.
It's SOFI, right, Pat? So it's basically based off a floating rate. Or put LIBOR versus SoFi, or it might be SoFi. I can't remember. I think it is SoFi, right? But anyway, the reason why this is important, guys, is that there were these loans that would allow you to only pay the interest, not the negative interest or negative amortization.
Just interest only.
And Thornburg Mortgage used to be one of the top lenders leading up to 2008, the mortgage housing crisis. So they would allow you to pay a 1-month LIBOR, London Interbank Offering Rate.
Yep.
You could do a 3-month, a 1-year rate, a 3-year rate, 5-year, 7 or 10-year rate.
Yep.
And so my recommendation to my client, who was a sophisticated borrower, this guy has his master's in engineering. He's a bright dude. He understands finance, probably more so than a lot of financial professionals.
Yep.
And so I said to him, sir, I just said his name, shit. But anyways, I said, sir, I think we should use the 1-month rate. And here's the math and here's the reasoning. You can afford today to pay your mortgage off. You've got the assets, you've got the cash. But Pat, you remember these days, the 1-month rate back then was like 1 point whatever.
Yeah, they were low.
And plus the margin that Thornburg put on it, he was just under 2.
Wow.
And so there's some 30-year fixed rate.
Yeah.
I've got a mortgage now of 2.75 on my and it's awesome.
Yep.
That's like free money.
Exactly.
The reason it's free money, and I would love to get your public accounting take on this, is that now we're talking about arbitrage, or delta. Here's my cost of money.
Yep.
Here's my rate of return.
Yep.
If my rate of return can outperform my cost of money, would you, from a tax professional or public, I don't want to put it in the tax world, just public accounting, is that the way you measure it? Is that the way you look at it?
There's definitely, I mean, you can look at that delta because there's really, I think the tax advantages for the average person of owning a home have diminished.
Because of standard deductions
Exactly.
being so high?
Exactly. But you're absolutely right. If my investment is investments or my portfolio is returning an 8% and I'm borrowing at 3%, why in the world would I ever pay the mortgage off ahead of time?
Right.
I would just put more money away.
Yeah.
Whether you're putting it into a retirement account or just investing it into the market.
Right. And there's guys like Dave Ramsey, and we'll pick on Dave. I actually think he's helped a lot of people who are in a certain sect or class of maybe really bad consumer debt, maybe really bad money disciplines or bad money philosophies, that he has a market of people that he's really helped.
Right.
But those who understand arbitrage or delta, like a public corporation would.
Yeah.
You know, a public corporation understands how to leverage
Right.
debt.
Absolutely. Yeah. No, I'm a believer in Dave Ramsey. I believe about 80% of what he says.
Yeah.
And, we try to follow, my wife and I try to follow a lot of his principles, living debt free.
Sure.
And I think where he misses the mark is, waiting till you have 20% to put down on a house. You're going to basically never catch the golden egg. I mean,
you're going to stay below the table. If this is par, you're always playing catch up, right?
I would have bought a house. I would advise somebody to buy a house as soon as possible.
Yeah.
Because if I just look back at what's gone on historically in our market, if I would have bought a house in my neighborhood 6 years ago, I would have paid $300,000 for it.
Yeah, that's wild.
A house 2 houses away from house similar very to mine, to that $300,000 house is selling right now for $800,000.
Wow.
It's it is a little bit more than many markets, but that's the type of increases we're seeing, and now you're coupling that with higher rates right now. It's just forcing a lot of people to be unable to buy.
SOFR, SOFR, he found it for us.
Oh,
up there.
There you go.
We have a monitor behind us, guys, that we can look at what's going on. You should be able to see it on your screen.
Yeah.
What does SOFR stand for, Jake? I don't have my spectacles on. Did you find it there?
Secured
overnight financing rate.
Yeah.
Secured overnight financing rate. So that's what institutions loan money to each other.
Exactly.
Right?
Yep.
So there's those products. Does Movement Mortgage, who you are a mortgage broker for now, a mortgage loan officer?
Yeah. Loan officer. Yeah.
Not a broker. I got to get my terminology.
Now we're a lender. Yep.
You're a lender.
Yep.
Absolutely a lender. Which means, what is the difference between a lender and a broker for people who are out there?
We're funding our own loans. So everything's done in-house.
But you still sell it, right?
Sometimes. Yeah,
Okay.
the servicing.
Servicing of the
we
loan,
actually,
yeah.
for the past few years, because the servicing was so valuable, we've been retaining all the servicing.
Interesting.
Yeah. We're starting to shy away from that a little bit right now.
And that's what got Thornburg in trouble, actually, back in the day, is they took pride in servicing everything.
Exactly. Big different market than it was.
Right.
Going back to your '08 to the current, we do so much due diligence on the borrowers. It's not like it's stated income. It's not like, it's no doc. I mean, we're getting everything, including DNA, to get somebody
DNA
across.
being
DNA.
DNA.
Yeah, DNA.
Blood. You're taking the blood sample.
We're taking blood samples almost to get them to the closing table, which personally I think is great. I know that when a client goes to the table and they close on their house, there's a very, very, very strong likelihood that they will not encounter difficulty making their mortgage payments. And that is the most important. That's
Duh, right?
Yeah, I mean, I've always taken it as the consumer is going to be a client of mine for life, not just for that one house.
Yeah.
And the last thing you want to see is a family evicted from their house.
Right.
And
It's bad for the individual. It's bad for the economy.
it's bad for the economy, bad for the mortgage.
So
company, bad
micro,
for-
macro.
Absolutely.
Yeah.
And so I think you just see less of that now.
Yeah.
Obviously there's circumstances, job loss, divorce, medical conditions that force that,
Right.
but it's not just a normal, hey, I overspent this month.
Yeah. So all of the loans, 25 years that you've done with your clients,
Yeah.
and you don't have to answer this if you don't want to. Can you think of anybody in that 25-year span that went into default?
Yes. Oh, yeah.
Wow.
Yeah.
And-
No doubt.
Number one reason you think a person's gone into default, your personal opinion.
Divorce.
Divorce.
Divorce and medical. That was it. If you look at most families in this day and age, you have two incomes in the household, the husband and the wife, and all of a sudden they get divorced and they don't, if they have
What
children.
are those called? Danks or what are they?
Well, if they have children, it's not a dink, I don't think.
A
I
dink.
think
Dual income, no kids.
Right.
Dual income.
Yeah, that's usually not as bad. But when it takes two incomes to really cover the mortgage and all the household bills, that's where when a divorce happens, it's just never good.
So in 25 years, you're just a swag here, wild ass guess
Yeah.
of loans that went into default that you were
That I
you were-
originated.
Yeah.
Oh, God. Not many. Not many.
So is it something that you think with where we are today, we had this artificially low interest rate environment, we had this quantitative easing of 12 plus years, 13 years,
Yeah.
maybe 20, going all the way back to dot-com bubble burst. And even though there was that period where rates went back up, but 2008 put us in an artificial environment again.
Well, I think with the low interest rates, I mean, I don't know that. I think right now what we're getting ready to encounter, and I don't know how bad it'll be, but, right now defaults are very low
Yeah.
across the board in the mortgage industry right now. I think that's going to change.
I agree.
What you're seeing right now is people are out spending money, and we see, all these figures coming out every day, but, people are just running up charge cards.
Yeah.
Retail sales are going through the roof, as well as inflation. So now people are paying more money for these consumer goods, not to mention just the things they need to live on, including utilities, gas, rent,
Yeah.
whatever the case may be.
That's why I wanted to bring you on today, because I'm starting to see, not with my existing clients, because I'd like to pat myself on the back and say I've take some credit in how I've helped people just have better financial disciplines.
Yeah.
And a lot of our clients we work with are in the retirement distribution phase.
Right.
So now they got to think about maybe the mortgage as an asset.
No, you're absolutely right.
And when you say mortgage and asset in the same sentence, it sounds weird, but I'll come back to that. We'll talk about that today. But, for this other consumer who's in the pre-retirement phase, in the accumulation phase, or still in their accumulation phase, they're still saving money. They're still paying on their 30-year fixed mortgage or their 15-year if that was their fancy.
Yeah.
But what I'm seeing, Pat, is that these 2.75 rates that people secured, or two whatever,
Yeah.
they felt wealthy. They felt rich. And then they went out and said, well, man, I've got my McMansion now.
Yep.
Let me go out and decorate it and put some nice pool furniture,
Let's put a nice car in the driveway.
put a nice car in the driveway.
Yeah.
And all of a
boat
sudden,
in the
consumer credit
Yeah.
went up. And so, and I know you'll understand this as a CPA, and you're probably talking to your clients about this, is that now I have to go back and look at what their overall average cost of money is.
Yeah.
And it may make sense. This is going to sound really
Oh,
harsh.
Believe me, I know exactly where you're coming from.
It may make sense to refinance at a higher rate than your 2.75.
Yeah. We
And
work.
help from an accounting point of view. Help
Yeah.
me
Okay.
help the world understand why that's important.
So this is so funny. We work with a number of different national advisors and so forth that really work with lenders to help lenders do more business. And, one of their big things is, hey, you need to reach out to your clients and see what their, overall interest rates are on all the other debt. And because there's so much equity out there in the world today, it might be a great opportunity to refinance the boat, the car, and the house and take it from that 3% to the 7%, whatever the case may be, to save on their monthly cash flow.
Yeah. I'm just curious.
And
hold that thought. Jake, fact check Pat and I. Well, fact check me, because I'm going to make the statement. If I remember right, if I go look at the that's right. So go Google it and tell me what Google says is the rolling 30-year. Let me think of a way to say
historical average.
Yeah, the historical rolling 30-year average on mortgage rates. I shouldn't have taken that last sip. Now I'm losing my thought on how I want to pose the question to Google. But my guess is it's in the high sixes.
Probably 6, 7. I mean, I remember buying a condo here in Virginia Beach, and it was 8.5%.
Yeah. 1990s?
Yeah, it was late 90s.
Can't see what that says, but what are you finding? Jake, are you there? Are you on
sorry,
break?
1 second.
He's taking a coffee break in the studio.
That's fine. That's fine. I give everybody needs a coffee break. Yeah.
Oh, there you go. Sorry.
Setback rates in the long term.
Yeah, 7 3/4.
Wow, I was off by 150 basis points here.
Yeah.
Wow.
Yeah.
Higher than what I thought.
Yeah.
So
my thoughts on this whole thing, and so we have a couple of advisors, and for lack of better words, their mission is to help mortgage originators do more loans.
yeah.
And there is something to be said. If you're not making your payments, okay, if you have the equity in the house, go ahead and refinance your house, take it to current market rate, pay off your car, pay off your credit cards, pay off the boat, yada, yada, yada. I think that is where I just almost get sick to my stomach, because I think where we miss the boat is we're not doing enough to educate people to live within their means.
Yeah.
And I think at the end of the day, that's where you could take a lesson or two from Dave Ramsey,
Right.
because I think that's where he does get it right. Not necessarily on the mortgage end, but on all of the revolving debt, on the installment debt and stuff.
Absolutely.
People in general just live below
Above their means.
They live above their means. They need to be living below their means a little bit. Does it make sense to do it? If you're struggling, if there's no other solution, people tend to find the easy way out. Yeah. I was on my way into the office this morning, and, in case you did not know this, we now have a shortage of these drugs for fat loss. And they're
Ozempic?
Is that what it's called?
Yeah,
there's a shortage, and they're now making this is a national, disaster, because people want to look good to get on the beach or go on beach vacations this summer. So meanwhile, I'm listening to this for 15 minutes while I'm driving about why we have a shortage of this. So that's the kind of world we live in right now. Everybody wants something easy. They want it for free. I think if these same individuals would spend a little bit more time working on their budget, as opposed to just out blowing money, they wouldn't have that problem. You know, these low interest rates on these houses were a blessing. Whether it allowed you to pay off your mortgage early if you wanted to do so, not necessarily the best thing. You know, when it's an option.
Your pick, your poison, right?
Right. Or maybe invest a whole lot more money into your retirement.
Yeah.
You know, live today so you can live tomorrow.
Right.
Those type of things. But I think a lot of people, like you said, they took the 2.5% interest rate or whatever the case may be, and you know, then turned around and got the BMW or Mercedes or the boat or whatever the case may be.
And no disparagement on any of those, but is it within your means?
Exactly. And then all it takes is that one speed bump, and somebody loses a job. Somebody, whatever the case may be, somebody gets sick and can't go to work. And then, all of a sudden life's hard.
Right.
We see people every day, with 15, 20 credit cards. I don't even know how the hell they could manage to remember to pay them all. I mean, I'm a CPA and I'm like, okay, we have one card we have to pay every month. And that's, I got to remember to do that some days, it's like, fortunately, American Express sends me a reminder.
American Express, right.
God bless them.
Shout out American Express.
There you go. But
the charge card versus the credit card.
Yeah, and they've even kind of gotten out of the box now where they're like, hey, you can finance this, and I'm like, yeah, the rates they charge, who the hell wants to finance it?
There's 4 rules that financial institutions have. I don't know if you've ever heard this or not. So
no, I'm not sure.
I use a planning system with our clients called LEAP. It stands for Lifetime Economic Acceleration Process.
Okay.
And we use this model, this personal macro and microeconomic model.
Uh-huh.
And it's made up of your protection components, from car insurance to life insurance, your savings components from a checking account to tax-deductible savings like IRAs, 401ks. And then we call it the growth component, which is everything from a government bond to business or tax shelters, real estate. So there's 27 places, Pat, that people can put money. Only 27.
Okay.
Now there's a plethora of thousands of products. There's probably thousands. I don't know if there's thousands. There's probably dozens of mortgage products that a person could pick from.
There's probably hundreds.
Hundreds.
Yep.
No, I have no clue.
Yep.
So hundreds of mortgage products, hundreds. I don't know how many mutual funds there are today. I think there's over 10,000 still.
Yep.
Mutual funds in the marketplace, exchange-traded funds, individual stocks, insurances, annuities. So there's 27 places money can go. And it doesn't matter if you're Jeff Bezos, Patrick Bowler, Kenny Porter, it'll fit in our model.
Yep.
And it was created by this economist named Robert Castellone, who turned financial expert. So I've been using this since the 1990s. And what I have found to be true is that most human beings focus on emotional feel good, so they let their emotions get in front of their logic. And folks will make an emotional decision, and then they'll come back to me and, well, Kenny, here's the logic. And they will try to make the financial logic, they'll try to make the math fit the emotion.
Math won't lie.
Math won't lie. And so what I try to get our clients to do is go, hey, when we're sitting down with Patrick Bowler and we start talking about refinancing a mortgage, cleaning up the consumer debt, the first thing we got to do is have some financial therapy and go, are you committing to not repeat these things that you did in the past? And if we can take a 2% mortgage and now, damn it, it's got to be 7%, but it improves the cash flow.
Allowing you to invest more.
So one of your guys downstairs, I referred a client to him last month, and this is mind-boggling to me. The client has very, very good income.
Yep.
But they got ahead of themselves.
Yep.
And their debt exposure was $8,900 a month of just debt, credit cards, mortgages. And so we cleaned that up.
Yeah.
We gave up a 2.75% mortgage, but we cleaned that up and freed up $7,000 a month of cash flow.
Yeah.
Not seven, $6,000 a month of cash flow. I misspoke. Sorry, $6,000 a month of cash flow. Their cost of money on the new debt now is 6.
Yeah.
But the overall floating average of their debt
Yeah.
was almost 20.
Yeah.
So when I look at that and I go, well, how do I justify telling the client to give up 2 to take 6.5, or it was 7.25, I think it was.
Yeah.
It's really easy. If you will take the discipline
No, you're absolutely
to
right.
put that $6,000 a month
And
in
the
your
other-
side account.
And the other thing you need to factor into that is, I mean, how long is that individual truly going to be in the house?
Right.
You know, I mean, most homeowners, I think the average in Hampton Roads is 6 or 7 years. They're going to
Yep,
own the
I think
house.
that's been the average for 100 years.
Yeah,
7
so
years.
6, 7 years. When you take that into consideration, it's not as bad as it sounds.
Yeah.
You know, and it's just one of those things. You can't hold people's hands as they're going out charging up credit cards every day.
And what we try to do with our clients, and I'm sure you do too, is say, okay, go back. If it's not us, go to your financial advisor
Yeah,
and look at what you can do with those dollars that you were spending anyway. So if you were paying the debt,
yeah,
and you were paying the debt at a level where you were just maintaining the balance,
yeah,
which most people, you don't realize this, but your credit cards on average 23 years to pay those things off if you pay the minimum payment.
I'm surprised it even gets paid off. Period.
It's crazy. And it may
That's
be
the
with
business we should be in.
That's right. Issue credit cards. But what's interesting about that, Pat, is that if you take that same person and you go, okay, pretend to be
Yeah,
the person in dire straits, the person in bad consumer debt,
right.
and now use a Ramsey strategy, use your envelope system, whatever,
Yeah,
and just take that same payment that you were making that kept you out of bankruptcy,
yeah,
and you had the cash flow to do it over the same amortization period,
oh yeah,
recapture that money, and you will be a multi-millionaire just by recapturing debt.
yeah. But you've got to change that behavior.
Gotta change the
and,
behavior.
you know, and that's the hard part.
Right.
That's always been the hardest part. You know, for people in general. And the first time I saw that Ramsey strategy work, I was absolutely amazed because a very close friend of mine had come to me, and this is years ago, but they'd come to me to refinance their house, and we did. And that was back when, you know, it was like we were doing these VA streamline refinances.
Yeah.
But the credit scores were horrible. But because the rates were so much less, you know, the VA just allowed a quick streamline process. And so we did that and got through it, and you know, and it was like a year later, the same, and you know, and the credit scores weren't great, debt was there, and I was just like, man, this is horrible. And people were being shipped overseas left and right at the time, and you know, and so it was about a year later, and they came back to me and they were like, hey Pat, we want to refinance the house again. And I am like, oh my God, you know, these are very good friends of mine, and I was like, okay, let's talk about it. And so did the loan application, pulled the credit report, and, you know, with these VA streamlines, they're very simple loans. You know, there's not a whole lot to them, but you do pull credit. And it was like all the debt was gone. And I called this girl up, and I was talking to her, and I said, did you guys inherit a bunch of money or something? I was like, where the hell did the debt go? You know, I was like, because, I mean, you just know that something's wrong here. And she was like, no. She said there was an advisor. I guess Dave Ramsey hires individuals around the country that work as advisors.
Yeah, right.
This gentleman had come on to base, and he had actually, you know, helped out a number of the spouses that were, you know, because their husbands were deployed. And she and her husband bought into it. And they literally, I mean, I remember, God, 15 years later, they were still using the same principles, still living debt-free. And it was really cool to see.
Yeah.
You know, I haven't seen a ton of people that have been so good about it. But that was one, I mean, I just brag about him all the time now, and he's
That's
since
a
retired.
great story.
They live in Texas now. They're living a great life, and they still to this day don't have a dime of debt,
That's
including mortgage debt.
awesome. Wow.
Yeah, so
And today's environment, that's
huge.
pretty huge. Yeah.
Yeah,
Yeah.
yeah.
Your opinion, and we'll talk a little bit more about traditional mortgages.
Yeah.
Your opinion on where interest rates, and again, past performance, not indicative of
No.
future, but where do you think interest rates are headed?
Next
Up, down, staying the same?
next 2 years, I think they'll fluctuate, but I don't think they're going to go down into the 4s or 5s. I
Yeah,
think
those days are-
I think those days are gone for a while.
Yeah.
But who the hell knows when you start looking at our political environment, our world environment. I mean, there's just so many factors that I personally, let alone economics, and those guys have a lot to do with it. I mean, one day they're talking, we're going to have 6 rate
Yeah.
cuts between now and the end of the year. And then this morning they're talking about possibly might have a rate hike.
Right.
I'm like, so I don't think anybody really has that, that.
Well, to that point, I could kind of see where the Fed would take that position, because when I go out on the weekends and I look at the Target parking lot and shopping center parking lots, and I see the Amazon trucks in my neighborhood, house after house after house, delivering boxes. And in complete transparency, we get a lot of Amazon deliveries to my house.
Yeah.
We keep the corrugated cardboard industry in business.
Absolutely.
That's a pain in my. That's a whole nother podcast talking about cardboard. But
Well, even a bigger pain in my ass is my dog. Every time an Amazon, UPS, FedEx, and the mailman comes by, goes batshit crazy, and it's like, God, I remember
which is barking all the time. Then
barking all the time, and I just remember, when it was just the mailman,
right.
Amazon
Amazon trucks go through our neighborhood all the way up to like 10 p.m. at night.
Yeah.
I mean, that dude, Jeff Bezos, from a little apartment building in San Francisco, which
God bless
is a
him.
shit show.
Yeah, deserves everything. He's right there with Google.
Right. Right.
I challenge somebody to open up a dictionary or an encyclopedia and do research as opposed to Googling.
That's right. Yeah, there's people out there going, "What dictionary? What's a dictionary?"
Exactly. What's an encyclopedia?
Britannica.
Yeah.
That's why we
I'm
used to have
showing
those
my
on
age.
our shelves.
I know.
right?
I'm showing my age now. That's
The salesman as a kid. I remember the salesman who would come door to door, and each year would want to upgrade your
okay.
your library of Britannica
Yeah.
encyclopedias.
Yeah. That's
Jake, do you even know what a Britannica encyclopedia is?
I mean, kind of.
Jake, how old are you?
Yeah.
That's my son.
Yeah.
28.
Yeah.
20.
He probably
mind-blowing.
went to a Library of Congress or something and saw them in there.
That's right.
I think I remember them being on your shelves at one point.
Yeah, we did. We had a set of them still.
Yeah.
Even and I think Noah, my oldest son, is 32.
Yeah.
Yeah, so we're not too far removed. We had a phone in our house at one point in time.
I had a landline up until
land-
about 2 years ago, and it was due
Wow.
to having a security system in the house, and they were like, well, you got to have a landline to hook it up to, and I was like, okay, and sooner or later, I couldn't take it anymore.
Now it's over cable, right? Where they're using
Yeah.
Wi-Fi now.
Everything's
Wi-Fi.
internet.
Yeah. Okay. We could get on a whole another podcast about that technology, planned obsolescence, and
There
technological
you go.
change. But I was talking earlier about these mortgages and the 4 rules of financial institutions, and I never explained that, so I'm coming back to it.
Okay.
So, in our opinion, the 4 rules of financial institutions, from mortgage companies to banks, insurance companies, mutual fund companies, financial institutions, and the largest of those, Pat, being one that you used to have to deal with all the time, is the federal government, Department of Treasury,
Yep.
down to the Internal Revenue Service.
Love them guys.
Yeah,
Love those guys.
love to hate them.
Stay the hell away from me.
So those 4 institutions, those 4 rules of those financial institutions, they can be really narrowed down to this, in my opinion, and the way I've been taught about economics. Number 1, financial institutions want your money.
Absolutely.
Number 2, they want it on a regular and ongoing basis. Number 3, the financial institution wants to hold on to your money for as long as possible.
Sure.
And then number 4, when you want some money back, how much do you think the institution wants to give you back?
Not much.
As little as possible. So when we understand those rules and we understand from a financial world how to manipulate or persuade, manipulation always sounds like a bad word, but how to persuade the rules to be in your favor versus the financial institution's favor, that's what I'm all about.
Yeah.
And so there's a product that came around, I guess, 25, maybe 30 years ago now, called a reverse mortgage.
Yeah.
How long have they been in the marketplace?
You know, I'm not positive how long they've been. Longer than I've been around.
Yeah, I've been in the business 27 years as an advisor, and I want to say the 1990s I started seeing them.
One of the gentlemen that works, or the gentleman that started the Movement Mortgage, I mean, he had a lot to do back in the day when they were, originally coming out, helping with the processes and stuff. But they've changed a lot for the better, maybe.
Yeah.
But they've changed a little. I shouldn't say a lot, a little. But it's not the product it was. There, back in the day, people felt like they were being taken advantage of, so forth, so on. It's now pretty much.
And there were those outliers out there, bad guys, bad lenders.
Absolutely.
Just churning
Yep.
accounts.
And now what you have is you have a HUD-insured product. It's very, I guess it's safe, for lack of better
And for
words.
folks who aren't familiar with HUD, what does HUD stand for?
Housing Urban Development.
Okay, and what is their responsibility to the industry?
They set the standards, the rules for government loans, that non-veteran loans, but for the FHA loans and so forth.
So no matter which lender you go to, there's going to be a baseline.
Yeah,
that's
they've
similar?
got to all meet the same guidelines.
Okay.
If the loan gets audited, for lack of better words, they'll check to make sure that it's meeting.
Did you follow the guidelines?
That you follow the guidelines.
And if you as a lender do not follow the guidelines,
And the loan gets kicked back to you.
and so you're responsible.
Now you're
for,
responsible for it, and you've got a big loss on you.
Yeah.
So it becomes very important that you have great underwriting, that you measure twice, cut once,
Yep.
for lack of better words. And there's a lot of pressure. There's more pressure probably on underwriters in the mortgage industry right now than there's ever been.
So before we get into unwrapping a reverse mortgage, and I know we'll do this in the show with some guys in your firm who are experts in this area.
Exactly.
But from your position as an accountant is the way I would like to look at it today.
Yeah.
Can you explain to our audience what a traditional 30-year, 15-year amortized mortgage looks like compared to that of a reverse mortgage, and what does reverse mean?
Yeah. So reverse mortgage is exactly what it says, and it can come in a number of different ways. But for somebody that owns their house free and clear, they're basically sitting on a ton of equity. They can use that equity there's what's referred to as a reverse line of credit.
Okay.
They can use that equity in their house to fund monthly payments to themselves, for lack of better words, and to.
Are there taxes on that?
There is. It's no taxes. I'm sorry. There's no taxes. It's tax-free money.
Because it's a loan.
It's a loan.
And IRS doesn't deem loans traditionally as a
No, you're just using
taxable
the equity
event.
in your home. So you borrow that money. The more you take out, it's growing every month. The interest accrues on it, but you're not paying it. That being said, you do have the opportunity or the option to pay it. The benefit of it is, depending on your age, one, you may choose to use the money to live on. You may choose to use the money to take in lieu of Social Security. If you're 62 and you'd rather not start drawing Social Security benefits right now, you could be using the equity in your house to get you to 70 to increase your Social Security benefits.
But Pat, Social Security is going to go away. What?
Yeah, come on now. Who knows? I'm not going to make that. I'm not even going to go down that path with you right now.
Well, I'll be really quick with you. If Social Security goes away, guess what's happening to your real estate?
Everything's going away.
Right.
I don't think that's going to happen. But there's just a number of planning opportunities, and until recently, I never really dived deep into it. like we mentioned earlier, with the standard deduction being so large in the United States right now for tax purposes, there's not a lot of benefit to owning a home from a tax perspective. I mean, the increases in equity are ridiculous right now, and I don't think that'll change significantly in the years to come either. But that being said, I'm not I mean, I take the standard deduction on my taxes. I don't.
Interesting.
So it's not like I worry about, okay, did I pay any interest or whatever this year? Not really. There's tax planning strategies that work with a reverse mortgage where you can lump up interest and make payments on it if you want. And that's something financial advisors we work with.
So maybe looking at tax deferred accounts like an IRA. Should we start taking distributions?
Take
to
distributions. There's so many different things you can do
Yeah.
with it. The guys that we have hired at our company, we just actually brought these people on, and they're some of the most successful reverse mortgage professionals, and they strictly work with reverse mortgages. They don't even know how to spell forward when it comes to a forward mortgage, but they get it, and and they work with our customers alongside our financial advisors to make sure that the plan fits the borrower.
So why the bad name? What do you think really created the bad name for?
I think
a
at the
reverse
end of the
mortgage?
day, I think families create the bad name. Mom and dad take out a reverse mortgage. They have the reverse mortgage for 20 years. The mortgage grows. Mom and dad pass away, and all of a sudden the kids inherit the house, and there's not as much equity as they were
So
expecting.
there's no inheritance.
There's no inheritance.
Or little inheritance.
Or less, yeah. And I think that is where the bad, and I think people, once again, and it's just the way people believe these days, they get used to not making a payment, but they don't realize that there is consequences, that the mortgage is going up. You are using the equity in your home. The way the numbers are skewed, very, very seldom, unless we have just a housing crisis and values drop completely, will you ever outlive the equity in your home. That being said, it's a non-recourse loan, meaning, the family, whoever inherits the property, they're never responsible for paying
The
more.
debt does not become their debt.
No, matter of fact, if they wanted to pay the debt off, they're only responsible for 95% of the value of the house. So if they wanted the house.
All right, so let's do some math on that real quick. We'll do some quick, I call it Jethro math.
Sure.
I've got a house worth $100,000.
Yep.
And these are not factual numbers. This is just make believe. But I got a house worth $100,000, and my reverse mortgage is $50,000.
Yep.
Mom and dad pass away.
Yep.
What are the kids' responsibility on that $50,000 mortgage?
Pay off the $50,000. If the house is worth $100,000,
and if they want to keep it.
They want to keep it, they pay off the $50,000 and the house is theirs.
If they don't want to keep it, does the bank take their equity?
Nope. No, the bank will basically give them 6 months, and then they'll extend it to a year to actually sell the house. So bank's not keeping anyone's equity. And if the bank basically takes the house and sells it, they're still going to get the difference.
So let's say the house is $100,000 when mom and dad started.
Mm-hmm.
They rack up $50,000 of reverse mortgage debt.
Mm-hmm.
That they were never responsible for during their lifetime to pay back, non-recourse to the kids.
Right.
And then we hit a housing crisis, and the $100,000 house is now worth $40,000.
Yep.
Lost 60% of its value.
Yep.
What are the kids facing now?
95% of $40,000.
95% of $40,000. And so they could actually then say, hey, Mr. and Mrs. Banker, we're just going to let you have this house back, and you recoup whatever you can recoup.
That becomes a HUD foreclosure. And, we are seeing some of those, right now. You see a few of them. I've actually got, and I don't know the details of how long this individual had the loan, but the parent passed away. The daughter inherited the house. The debt on the house is around $200,000, and they're going to end up. They're actually waiting for HUD right now to do the appraisal, but they feel that it's going to appraise for probably somewhere in that area of 200. So she's expecting to pay somewhere around 180 or something like that to pay off the loan. Now I believe that her mom or it was either mom or grandmother, had that reverse mortgage for a long time, which God bless her, you know.
Wow.
You know, so
Which you have to look at that for the individual. I think a lot of times children become maybe they overemphasize that they didn't get anything out of that.
Right.
But what about mom and dad that actually
Exactly.
owned the property? It was
Right.
their asset.
It was their asset. Yeah.
Right.
They gave you an education. For gosh sakes, they raised you.
Right.
Yeah. So yeah, no, you're absolutely right.
So that asset, when we look at that, and when I look at that with my clients, and Pat, I can't tell you how many times I have said to my clients, "Hey, you should go downstairs and talk to the folks at Movement, or go talk to
Anybody.
mortgage.
Right.
It doesn't have to be Movement.
we prefer it be movement.
We prefer, yeah, sure. Great lender, right?
Right.
You guys have done a great job in the community. And to your point earlier, that man, when you're giving over half of your profits, or
Yeah.
not over, but half of your profits away to a foundation
Yep.
to support the community,
Yep.
that's pretty easy to get behind.
Exactly.
But when children are working with, and I would encourage you that if you have an elderly parent, go into a meeting with Pat or any of the team members at Movement or any other lender. Son and daughter, go with your mom and dad and hear the proposal, hear
Yeah.
the strategy.
Yeah.
Because it is a family decision if
Yeah.
mom and dad has a desire to leave wealth to the future or leave a legacy to a
Right.
future generation.
I mean, I think at the end of the day, most children want to see their parents live their best lives.
Yeah, their
Yep.
best life.
Their
The
best,
mom and
the
dad's
mom
best
and dad's
life. Right.
best life. For lower middle income families where the house is the asset,
Yeah.
there's not a lot of financial assets behind it. You know, changing from maybe having a $500 to $1,000 mortgage payment to having no mortgage payment is life changing.
Yeah.
Most children would rather see their parents support themselves with the equity in the house than the children having to give the parents money on a monthly basis.
Interesting.
And especially when we get into lower middle income families.
Yeah.
You know, you see, saw something on the news last night. I try to stay away from the news, but they were really talking about how more and more children now, the parents are moving in with the children, and there's a financial strain and so forth, so on. This is something a reverse mortgage can keep people out of assisted living, keep them in their house longer. It's just amazing the powers of this loan product for the right people. It's not necessarily appropriate for everyone. The gentleman that just came over with this whole team to Movement in the past year or so, you know, he and I were talking. He was like, "Yeah, it's 62. I took out a reverse mortgage on my house." He goes, "Because it makes sense when you start looking at the math behind it." For myself, my wife, it'll probably be as soon as we know that we're in our final house, whether that's the next couple of years, we'll probably do the same thing.
Now, and there's some products out there, Pat, now that you can do a reverse mortgage purchase.
You can, yes.
Tell me about those.
So I sell my house, or whether I sell a house or buy a house, but, you know, and let's just say I'm 70 years old and I want to buy a house using a reverse mortgage purchase. I go in there, the house is, and we just make up some quick numbers here, but let's say the house is $500,000 and I just sold a house and I got a check for $500,000. Well, rather than put down all the proceeds, I put down the required amount. Let's just say it's $250,000. So now I've put $250,000 down, and I have a reverse mortgage for the difference, that $250,000. I take the other $250,000, and now I have liquid cash that I can live off of, or I can give to my children.
Yeah.
Now take this one step further. If I use that $250,000 to turn to my children, let's just say they're 30 years old and they're ready to buy a house and raise a family. Well, hell, now I'm giving them the down payment for a house.
Yeah.
Think about changing their lives that way, as opposed to waiting till I'm dead to give them the proceeds from the house.
Right.
Because what's going to happen 30 years or 20 years from now when I die, the price of houses are going to be a lot more.
Yeah.
So you can make a big change in somebody's life using this product if that's what you're aiming to do.
Yeah.
For some, it's to save their lives. Others, other people use it to change their children's lives sooner than later.
And a reverse mortgage, I think there is a misnomer out there. They're only for middle class to lower middle class,
Yeah.
but there is high net worth.
Oh my gosh. It's life change. I mean,
Yeah.
you obviously work with a lot of net worth people. It's amazing when you start talking about tax-free money,
Right.
how that changes
Yeah.
things.
Yeah.
That's
And that's where you really have to step back and look at it from a personal macroeconomic
Yeah.
point of view, that it's not product driven. It should be process driven.
yeah,
That when we look at the marginal rate versus the average or effective rate
Yeah.
of a financial decision from a tax point of view,
yeah,
and then look at the cash flow.
yep,
I mean, those are all compelling reasons. And, I have to say in our industry now,
yeah,
it's becoming more acceptable that product is a tool that should be seriously looked at
Consider.
in the retirement distribution phase.
Absolutely.
Don't have to do it, just consider it.
right, yeah,
And I say to my clients all the time when they come in, especially with new people come in our firm, and you may have something similar you say, but I go, hey, Mr. and Mrs. Client, when we're done with this analysis, you're looking to us to provide financial advice, strategy, that fiduciary word. We have to do what's in your best interest.
exactly.
We have a commitment to you to do that. And maybe even for some advisors, it's a financial obligation
Yep,
by the duty or license that they fall under.
Yep.
But let's just say I'm just a good human being, and I just want to do what's right for you because I'm a good human being.
yeah,
But there are three things in being a good human being, being a good neighbor,
right,
and walking through these numbers. Three things you can say to me. You can say, Kenny or Pat, that is a great idea. I love all the strategies you've presented me. Let's implement 100% of what you just said to do.
right,
And as long as we both understand our responsibilities in that, awesome.
Yep.
You take 100% responsibility for you.
yep,
I take 100% responsibility for me. We're good. But then there's that occasion where you go, emotionally, I just can't get through buying a reverse mortgage or buying an insurance product or buying a investment product. Everybody has their
yeah,
thing,
Yeah.
right? So you can implement 1% of what I say all the way up to 100% of what I say.
Yep.
That's your choice. And then there's the ultimate third option. You as a consumer can tell Pat or I in our strategy to pounce in.
I've had that happen too.
I have too.
Yep.
And it happens a lot.
Yeah.
Where a person goes, I just think you're batshit crazy, Kenny.
Yeah.
No way am I going to consider a reverse mortgage. And because you asked me to do that, I now just don't want to talk to you anymore.
Yeah, yeah,
And that's your right as a consumer.
sure,
And again, I'm not going to bash you for that, but I would just go, hey, the math speaks for itself.
yeah,
And now in our institutions of continuing education in our industry and
Right.
training, and I'm sure it's the same for the guys doing the reverse mortgages, it has now become a part of academics. It is
Yeah.
now, academia has said, hey, we should actually be teaching these strategies as an option for the consumer to make their own decision. And is it suitable in their specific situation? So what I would be saying to you today, and
Yeah.
please tell me if you think
Yeah.
I'm off base here. I don't think you will. But consider using a reverse mortgage as you head into the retirement distribution phase, as you head into your income phase of life.
absolutely. And I've talked to a number of people who, and you always know that there's certain people that can benefit by it. You just look at it, and you have a 70-year-old person that is working overtime to pay off their mortgage early, so she or he can finally retire. And I'm like, have you ever, it has more than enough equity. I'm like, have you ever thought about just breathing and not having to worry about it so much? You don't have,
Yeah.
I've talked to their children, and children look at me like I am just crazy. And so I don't get it. It doesn't make sense to me.
The emotion
The
overtakes the
emotion,
logic.
yeah, they're like, well, the interest rate's too high. I'm like, have you looked at this individual, 70 years old, working 2 jobs, working overtime to simply pay off a debt?
The interest rate's too high, but mom and dad will carry a balance at 23% on a credit card.
Right. So it's
I know it's not everybody, but
it is an emotional thing.
Yeah.
A lot of people just do not believe in them for one reason or another.
Yeah.
And you know what? And I don't argue it with them because I get it.
Well, it becomes religion at some point.
Absolutely.
You know, people
Absolutely.
believe in God and don't believe in God.
Yeah.
Catholicism versus Baptist.
Right.
I'm like,
Right. Yeah.
okay, pick your poison, but
Yeah.
at the end of the day, we're going to come back to the
When it
proof
comes
is in the
back to
pudding.
the math,
Yeah.
then you can make a case for it. And,
Yeah.
You know, and it's with the products today compared to what they used to be, I think it's a lot more advantageous to the average person. But, you know,
And so if you're putting on your CPA hat and let's say you're not the mortgage advisor in
Right.
this case, but one of your CPA clients comes to
Yeah.
you and says, Pat, I'm 70 years old now. I think the requirement for a reverse mortgage today is the youngest
62.
borrower was 62.
no,
right?
actually, you know, they that's one of the rules they changed. You can
I did
actually
not know that.
You can have a spouse that is below the age of 62, and you can still do a reverse
As long
mortgage.
as one spouse is 62.
Exactly.
It's the oldest of the two, not the
It's
youngest.
the oldest, and exactly the impact that the younger spouse has, I'm not exactly positive. That's a question for my professionals.
Does
but
it matter what state you're in, like the states that do community property?
HUD loan.
HUD loan.
Yep.
Just a HUD loan.
Yeah, so it's federal.
That's news. Oh, wow.
Yeah.
I learned something today on my
There
own
you go,
podcast.
man.
That's
I like
awesome.
that. See,
Yeah.
Bam.
It's a win.
There you go. Cheers.
Yeah, cheers. Or just an excuse to take another shot.
There
of,
you go. Just a sip.
bourbon whiskey.
Yeah, but you know, there's a mindset out there. A lot of people that just don't want to, go down that path. Some people don't need to. They have more than enough cash. They have the assets, and they're not worried about doing it, which I get.
Wow.
You know, but tax implications. You could save a lot of money in taxes, depending.
Yeah.
You know, if you're able. I mean, some people have to take distributions from the retirement accounts, but
Right.
more often than not, those people are taking a lot more than the minimums. So you could defer a lot of cash. You could also take a lot of that cash and push it out to your heirs early. Why not?
Yeah.
Right. So the planning opportunities for the wealthy or those that have a lot of assets are huge.
Yeah.
And that's where someone like yourself comes involved,
Yeah.
working alongside one of our reverse mortgage specialists. And
It's bringing the experts together. And, that's a great point that you bring up is that, me, myself, and our team, we're going to have a lot of expertise from a 40,000-foot view.
Yep.
But we still have to go down deep. And when we go deep, we need that mortgage expert
Yeah, exactly.
who specializes in that area. I need the CPA.
Yep.
I need the attorney. And it's in reverse of that. If your attorney is your trusted advisor and that's the quarterback of your team,
Right.
then all of the other advisors should be going, hey, Mr. and Mrs. Attorney,
Yeah,
what is your client trying to achieve? Here's our area of expertise.
absolutely.
And so it's really creating, as we were saying off camera earlier, it's that multidisciplinary practice.
And I think any person that is working with a CPA, working with an attorney, working with a financial advisor, they're going to have more confidence if all three of those parties are working together.
Right. And you can pick your quarterback, right?
You can pick your quarterback, yeah.
Yeah.
And I think especially when I was in public accounting, I mean, quite often we felt like we were the quarterback.
Yeah.
Sometimes we weren't, but we thought we were still. So, but more often than not, I think we.
Well, tax is such a driving factor of all decisions financially
Yes.
because you're either deferring it
Or
or it's tax-free or you're paying it.
Right.
And being able to understand those nuances.
Yeah.
And so I'm going to say take the mortgage hat off. We'll go back to the CPA guy. In the world of tax right now and looking at the U.S. economy and then looking at the global economy,
Yeah.
the tail that wags the dog.
Plan to pay more taxes.
So you took the words right out of my. I was
Yeah.
going to ask you, are taxes going up, taxes going down, staying the same? What's your personal opinion?
Personal opinion, taxes go up.
professionally, how do you deal with that when you're preparing a return?
Well, you plan accordingly for the following years. I mean, a lot of people right now are, using products like Roth IRAs or Roth 401ks as opposed to deferring the taxes. I think it really does have a lot to do with your financial advisor looking at the tools the individual has invested, when they're going to be pulling their money out, how much money they have to pull out, what the tax consequences are going to be, when they're going to be, so forth.
So I got to tell you a study that we did. This is a non-scientific study, maybe on a small test sample case, but I think it was back in 2007, 2008, before I sold my old firm. We had a number of tax firms that we work with that were referring us clients, and we were referring a number of firms.
Sure.
Your old firm being one of those that I think you specifically.
Yep.
But we took this one test case of a Verizon executive. It was a C-level executive, retired from Verizon. He had some real estate. He had some personal real estate investments. Gosh, back in the day when I'm trying to remember what the limited partnerships, when those were a thing. So he had a lot of stuff going on. He was a pretty wealthy guy. And we were trying to do some tax planning, and we were like, okay, let's take last year's 1040 and let's send it to, we had about 7 relationships with firms here locally and then abroad. And we sent that tax return, Pat, to 7 different firms.
Yep.
What answers do you think we got?
Probably at least 7.
7.
Yeah. Yeah.
But to this day, I'm still perplexed. What do you think? The accounting, is it practice? So is it skill set? What? Why would I get 7 different answers for that client in your?
What was the question you were asking?
Well, when I looked at the overall 1040, there were 7 different answers in what the total tax was that this client would owe.
Some people are acting a little riskier than others, maybe.
Okay.
Treating things differently. It's hard to say.
So the tax
so many.
code is, I think it's 72,000 pages now, or great.
28 years ago, I might have been able to answer that question.
You're a mortgage professional.
Yeah,
now, right?
But there's
putting you on the hot seat.
Yeah,
here.
but there's so many gray areas in the Internal Revenue Code.
So is it the matter of how much risk the preparer wants to take and how much risk?
Well, I think and I think when the preparer takes it, he's taken a position he thinks he can defend.
Okay.
I wouldn't expect anything less.
And are these things, there are things called, and a lot of consumers probably don't know this, but if you make a mistake on a return, or if the Internal Revenue Service says you're out of compliance or suitability.
Usually it's the consumer that's responsible for it.
Sometimes the preparer, but there's preparer penalties, right?
There's preparer penalties. That's for negligence.
So it would have to be negligence.
Right. Yeah.
So most of the time it's the consumer who has the ultimate responsibility of providing good data.
Right. And more often than not, I think your tax preparer will go and defend his position. And I think more often than not, he'll be successful. Most good CPA firms, or most CPA firms in general, I don't even want to say good, but if they're going to take a position on a high worth individual, they're going to make sure they've dotted their I's and crossed their T's. They're not doing something, very few people are going to do it haphazardly.
Tell us the stages of compliance, if you would, just while I've got you here today as a tax professional, that if you prepare a tax return and a person gets audited and they believe that their audit, let's go down the path of the audit, they believe that the Internal Revenue Service's opinion of their tax bill is wrong, and they want to fight it.
Yeah.
What are the steps?
Typically speaking, we'll prepare our case, send in the information, and it'll bounce back and forth a little bit. Very seldom, I don't go into that. I don't deal with that many complicated issues in general. Quite often, though, I think as long as you have your documentation correctly, and you send that in, you'll.
So big estates, when people hear about tax court, or private letter ruling
Right.
or those type things. It's usually large estates,
Lar-
right?
it's
Or
large
businesses.
large businesses. It's large accounts. Large, somebody taking a very extreme position, and sometimes they win, sometimes they lose. I would say more often than not, any experienced CPA doing that's probably going to win in the end.
Interesting.
Not always the case, but I think the success rate is definitely there.
Is there any strategies that you would just throw out there, kind of tips to folks listening today, like how they should think about when preparing their return? Or
The old saying is pigs get fat, hogs get slaughtered.
I love it. I use that a lot. Yeah.
But that's what I would say. I mean, it's pretty black and white. My father always used to, I grew up, everything was black and white. If my dad told me to be home at 6 o'clock, well, if I came home at 6:05, well, I was late. I think with the Internal Revenue Code, I think there is some gray area there. But for the most part, the majority of it is black and white. You have to be, as a CPA, you have to be able to defend whatever position you're going to take. And, and that's where you dive into the code and you're looking through to see exactly the wording and so forth. And you got to have your ducks in a row.
Yeah.
And if you are taking that extreme position, you surely need to advise the client of what you're doing so that if there is a surprise, it's not a surprise. If if it is,
And that comes back to the team again, right?
Exactly.
I mean, even though the mortgage advisor is not given tax advice, but it comes back to, well, what advice are you giving the client for, reverse mortgage?
Right.
And then you're working with your financial advisor who's trying to do forecasting, not looking in the rearview mirror.
Yeah.
And I'll defend you and every other CPA, EA, tax preparer out there, Pat. As I tell my clients this all the time, if you walk into your tax preparer on December 31st with a shoebox full of stuff and expect them to create miracles for you, you're already dead in the water.
Yeah.
Right?
It'll be an expensive bill.
Right. It is what it is.
Yeah.
And the bill goes up, and then the likelihood of you having the time to prepare a strategy with the team
tax planning is a year-round strategy.
Right.
I mean, you're looking at it from the beginning of the year to the end, and a lot of the work takes place during the summer months, making sure that.
So if you're an individual consumer, think like a corporation, right? A corporation's always thinking ahead,
Exactly.
forecasting, versus looking in the rearview mirror
Can't do anything after it's done.
Right.
Yeah.
Right. That's so much about life in general, isn't it?
That is true.
Man, let me tell you, being in here with you today has been exciting. What I would love to do with you, Jake, can you throw up Pat's website? If you want to learn more from Pat, whether it be a traditional mortgage, again, we have no skin in this game, whether you use a 15-year mortgage, 30-year mortgage, a reverse mortgage, an ARM, adjustable rate mortgages, those still a thing?
Rates aren't very good on them, so I don't know that they're, I haven't done one in years.
Yeah.
Just there was no benefit.
They're just not popular now because of where interest rates are.
Exactly.
And the yield curve is still a little wonky.
Yep.
This is Pat's site that we're sharing with you here. So if you go to patrickbowler.com, he is a representative of Movement Mortgage, one of our local Virginia. Actually started in Charlotte, North Carolina. Right?
Actually, it started right here in Virginia Beach, right on the floor below us.
Toby, shout out to Toby, right? Toby Harris and his partner
Casey Crawford,
who was a football player.
NFL football player for the Tampa Bay Buccaneers and the Carolina Panthers.
Awesome.
Yeah.
All right, so I need you to do me a solid and see if you can get Toby upstairs, get him to come up, and
I can make that happen.
Have a conversation. You're pretty good buddies with Toby, right?
I'm very good.
I went to church with Toby for a while, too.
Did you?
Yeah. And I watched Toby's hair go from...
Yeah. He almost looks like Jimmy Buffett at certain times.
It's cool. He's got the Jimmy Buffett hairdo.
He does have the Jimmy Buffett hairdo. Yeah.
Toby, we're just busting on him.
There you go.
But yeah, Toby's a great guy.
Casey's
big
a great
heart.
guy. Yep.
I don't know Casey personally.
Yeah.
I've never met him.
Most humble individual in the world.
That's awesome.
Yeah.
That's awesome.
Really cool guy.
Yeah, good outfit. You guys are doing great work in the community, Pat.
Yeah.
You're a great tax professional and mortgage expert.
Yep.
So appreciate what you're doing in the community. Thanks for coming on the show with us today. And
Thanks for having me here.
We're going to do part B here soon. So
Sounds good.
Maybe we'll do it over there. And
Do it on the couch.
As soon as the freaking couch gets here.
Man, got to get some furniture.
I know
Although I do like this table.
the table's cool, but people are still using the COVID excuse of supply chain. That I ordered that couch back in January, and it was supposed to be here in.
It's going to be a mighty special couch.
It's just it's one of those old English couches with
Okay.
tufted and buttoned it to try to make it look like
There you go.
an old pub. But it was made down in North Carolina. I wanted to buy from an American company.
Yeah.
But it was a leather couch that was made, and now the parts and pieces they're
6 months later, it's still not here.
Still not here.
Could have had that damn thing on the boat from China.
Could have been on. That's sitting in the
Yeah,
in the yard up in
exactly.
Baltimore, unfortunately.
Oh, that's true.
But yeah, that I don't know where I was going with that, but the bottom line is I'd love to get you guys back up here, and maybe we can do a group session on that side of the studio.
Absolutely.
That would be a lot of fun. But you're a great expert if you are in the market and are looking for a mortgage, either for refinance, purchase, or want to talk to your family members about a reverse mortgage. I give a big, solid endorsement for
Thanks,
Pat
Ken.
Bowler and Movement Mortgage.
Appreciate
And I'm not
that.
getting paid.
Not
to say
getting
that
paid.
There's no
Trust me.
there's
on
no
that.
compensation, and I've got to do all those rules.
Yep.
Pat's just here as a guest today, and if you call me and ask me, hey, who's the guy I would refer you to, Pat's on the top 10 list for sure. So thanks for coming out.
Ken, thanks
Great
for having
night.
me, brother.
Good seeing you.
Yep.
All right.
Cheers.
Take care, guys. We'll see you in the next episode.
All right, guys. Thanks.
Point wherever you're ready, speed 180.
Black box.